Good morning, good afternoon, everyone. Thank you for taking the time to join us today for our fall edition of ARIVE Partner Spotlight. ARIVE Partner Spotlight is a monthly webinar series that we host here at ARIVE, where we invite experts and thought leaders from the mortgage industry to talk about topics that are relevant in today's market and that can help you guys scale and grow your business. Fall has officially kicked off, as has the football season. And we have some big plays planned for you guys today. I'm so excited to welcome two of our recent partners, leadership team from Plaza Home Mortgage and Arbor Financial, for taking the time to join us today. I'll let the panelists introduce themselves, but they're going to discuss topics on how you all, loan officers, can unlock new market opportunities, and we'll also learn more about the NAR settlement. Before we begin, I'm going to tell you one thing about both Plaza and Arbor that you guys may not know about. I had the pleasure of meeting Ryan and David at their office in Santa Ana just about a month ago. And let me tell you, they have one of the coolest offices in town I have seen that will give any office in Bay Area tech company a run for their money. Interestingly, Ryan told me they bought the building, they gutted the whole office, and rebuilt that all over again from ground up. So congratulations. One interesting fact about Plaza, they are new to the ARIVE family. They joined us towards end of June, but they've been in business for more than 24 years. And Ryan and Mark have been with Plaza for about 16, 17 years. So a truly long innings at Plaza. With that, I'm going to hand it over to Jeff. Amy, do you want to say anything? Otherwise, I'll hand it over to our guest to get this going.
Yeah, no, just welcome everyone. Thank you for your time today. Thanks for everyone who's joining us. We've got a lot to cover and excited. So we'll kick it over to you, Jeff.
Awesome. Thanks, Amy. Harish, thanks very much for the introduction. Jeff Leinan, co-president of Plaza Home Mortgage. As Harish said, Plaza has been around for 24 plus years. I have personally been with Plaza for 15 of those years, which is a really long time in the mortgage industry. But I have done many things from sales manager up to branch manager, and now I'm co-president of the company. So super excited to be here today. I think we've got a lot of really interesting tidbits, some thoughts, and Ryan will provide a lot of great information. So again, I want to kick it over to Ryan, and he can do a quick introduction.
Yeah, so first of all, I'd also like to thank everybody for taking time out of their day to join us on this. Hopefully, my goal is to provide some insight on how you can use a lot of these tools to grow your business, some nuggets maybe to kind of think about as we're all trying to fill our pipelines up. Rates are our friend, but so my name's Ryan O'Kane. I own Arbor Financial Group. We're a broker and non-delegated correspondent based out of Southern California. And I've been doing this since '98. So man, like 26 years. So definitely have my lumps and bruises, but looking forward to a great presentation. So thank you to Harish and Jeff and Mark for inviting me and giving me an opportunity to be on the call with everybody.
Great. Mark, you want to do a quick introduction?
Yep, happy to be on. I'm at Plaza 17 years now. I'm on my 4th job at Plaza, so been all around on the sales side, and really happy to be here. It's always great to see Harish and Amy, although I am really disappointed you guys didn't wear your outfits from the Great Gatsby party in New Orleans that I saw you in a week ago. So I don't know why we couldn't have had those on. I think everyone would have liked to have seen you in those.
Well, perhaps Harish can sing a song for us before we close out.
Awesome. Well, let's kick to the first slide and we'll get started. We really have probably 3 large groups that we want, or 3 large topics we want to cover today. First is really, we're going to talk about market opportunities in the non-owner occupied sector, and we'll get to some of those in a second. Then we're going to touch on the government market a little bit, and particularly refinance, and we're going to wander into some opportunities for loan originators in the refinance sector right now, which is, refinance is a great word that we haven't heard in a while. And it's nice to be talking about those right now for all of our loan originators friends. So we're going to talk a lot about opportunities, areas that you haven't necessarily probably thought about, and you probably need to think about to grow your business right now and going into next year. And then the third topic, probably the most exciting one, is we're going to touch a little bit about the NAR settlement. We're going to talk about what we're seeing so far, share some information that we've heard from other real estate partners. Ryan's going to talk a lot about what he's seen from his loan originators, and we'll again touch on some things about what you particularly need to be doing today to make sure you take advantage of the information. So let's kick it off with the non-owner occupied opportunities. Some of the information on the slide probably seems pretty basic. DSCR, we're going to talk about some pricing, and we're going to talk about renovation loans. But really, we want to touch more on what those market opportunities are. So I guess I'm going to start off with DSCR. I mean, the product's been around a long time, but how do we make sure that we're taking advantage of that? And Ryan, I guess I'll kick it to you and say, what are you seeing from the originators in your company that are taking advantage of this product, and how are they growing their business with it?
Yeah, so obviously it's a very important part of your tool belt as an originator. But I think what's interesting, and we had touched on this a little bit before we were setting up for the call, is there's originators out there that use DSCR as kind of a tool, and even when it comes to like renovation loans, non-owner second homes, they don't necessarily go out and try and build their business or to create. They don't look at it as a channel of business for them, right? They're typically using these product tools when something comes to them. So if they have a borrower or they have a realtor that is in need of a DSCR, or they're in need of an investment property, second home reno, then they choose to get smart on the product, and they typically use it as like a one-off, right? And look, I'm guilty of that too. I still originate, and it took me a while to kind of really embrace the actual additional market that is out there. So we have several originators that really embraced the non-owner occupied market. And that's when we talk about non-owner occupied market, let's just say it's the investor market. And when we're talking investors, fix and flip. You've got builders, contractors. There's this, if you really unpack everybody that makes up the investment property market, including CPAs and financial advisors, which we know are great referral sources, these products are really the bread and butter that drive that market, right? So what I would encourage everybody to do is think about not necessarily taking these tools to solve one-off loans, but really once you master kind of the concept of investment property lending, where can I go and find these opportunities? And we'll touch on that a little bit later, but I would like to just give you a quick example. So we have an originator at Arbor and this is hit true production numbers, that focuses solely on investment property lending. And in 2021, which we all know was kind of a rough year. That's when we first had this back half of 2021, they did 201 units. What's more telling is in 2022, which I would argue is when rates were really on the up escalator, they still did 194 units. And today, they are averaging 19 loans per month. And year to date, this was as of through August, had funded 151 units. And so when you think about that, this is a team that is just doing investment property lending, doing 19 units per month, right? And not only that, but I think is what's so telling is look at what happened to that market from 2021, 2022, 23, that market didn't go down. So I think that's would be a nugget that I would hang on to as an originator to say, it's more about the why, right? Because we all come on, these calls and people tell us about products and whatnot. And it's like, that's great. We've seen it before, but it's why do I want to listen? How can I take action on this? And how would this benefit me as an originator? And that right there, if you can, you've got somebody who does 19 units a month just on non-owner occupied lending. How many, I would just turn it over to everybody else. Like how many units do you do per month out of your current production pipeline that's just focused on investment property lending? But that just shows you what's possible.
Yeah, that's great. What I take away from that too is that it's really not a rate sensitive business, right? These are investors, and they're going to go out and they're going to purchase, pretty much in any market. So that's a great way to sort of level off your production in a very rate sensitive industry. So that's great feedback. Let's go on to the second question. Mark, maybe you can talk a little bit about, pricing and investment homes, second homes, and also the importance of probably pricing out DSCR loans, because with all the LLPAs on some of the investment stuff, there's other options out there that people should be aware of just to make sure that people are getting the best value.
Yeah, we've recently done some price improvements on our second home and investment properties. It's improvements outside of the rate sheet. So not many people use a rate sheet still, but if you did, it would be something that you'd want to use our pricing engine for that. And in some buckets, some note rates, it's over 100 basis points. So able to, these loans tend to stick a little bit on the servicing side a little bit longer. And so a little more value in there. We're now passing that on to our customers. And talking about pricing, we actually did a number of examples. And when you get into those higher LTVs where the hit gets really nasty, 80 LTV, you're talking 3 3/8 on a conventional. There are certain types of borrowers, depending on the prepay you're willing to add, where the DSCR loan does price out even better. So you'll want to make sure that you absolutely price both of those options when you're pricing it out, because sometimes it does, it does work out better for you. Talking about pricing a little bit more on your second homes. Second homes are really tough, when you get into the high LTVs, because you do have, you don't have the QM flexibilities. My advice on that would be, if you ever are dealing with an 80 or an 85 or a 90%, is you have to negotiate seller concessions up front. Otherwise, really hard to get those done and be able to ever pass QM. So that's just a couple tips as far as pricing goes on some of those properties. But it's a really good opportunity, as Ryan was saying. And Jeff, you want to keep going on renovation loans?
Yeah, well, let's just talk about that for a second. So in the investor world, we all know about fix and flip, right? But there's fix and hold too, and fix and hold really could be a renovation loan. So maybe you could touch on that, and then maybe kick it over to Ryan for what he's seen in the marketplace as far as some of the fix and hold opportunities.
Yeah, so the Fannie Mae Home Style, the Freddie Mac Choice, they both do allow the investment property renovation loans. And if you've ever done a renovation loan, a lot of them are very similar in the sense that you close, all the work is done after closing, and then we, as the lender and investor, deal with the contractor and the borrower. So as the originator, it's nice for you in the sense that you're done, the realtor's done, everyone's paid, they own the house, and all the work is done after. It can really create some good opportunities for those investors that don't have a ton of cash. Maybe it's their first investment property. They're trying to get their feet wet into this, but they know, they're buying more of a fixer-upper, and they don't have the cash to buy it cash, or and it's not something that might even pass an appraisal potentially. Whereas the renovation loan can take any house, one that needs repairs or one that you just want to upgrade, right? You would just want to be able to get a higher rent amount for it, or eventually sell it. We say fix and hold, but after 6 months, it is something that is eligible to be sold again once all the work is done. But primarily you're buying these for the rental side. So keep that in mind if you're looking at maybe getting more into it. You're going to want to have renovation loans kind of in your tool belt and know enough. And Plaza has obviously been doing renovation loans for 15 years, so very experienced in all the different renovation products.
So I will just add, if anyone has any questions, feel free to put them in our Q&A tab. So one question has come up, but if anybody in the audience has any questions for our panelist, feel free to add them in, and we'll take them as they come.
Awesome.
Go ahead,
Thanks.
Jeff.
Ryan, any comments on the renovation side and looking at potential fix and hold opportunities for investors that maybe are buying some more challenging properties?
Yeah. So again, from a mindset, and this is just coming, as from the originator mindset, right? So again, I'll remind everybody, I own Arbor, but I still originate, and I work really closely with our originators. And in my mind, it's all about how do you approach a product set from the originator mindset. And as I was talking about earlier, when we're looking at investment properties and getting smart on DSCR and getting smart on investment properties, and one of the terms you'll hear in there is fix and flip, which also kind of will encompass and embrace renovation loans. So if you're out there as an originator, if you're saying, look, I want to add another option into my tool belt, another product that I can go out and I can find and sell, you want to get very well versed, not just on renovation. Like, you need to understand all of the things that will go in if you're to buy a property, or if one of your clients comes to you and says, oh, I've got this beater that I want to go invest in, and it's like you know, it's like a tear down, and I don't know if it's going to appraise or like what's going to be the best type of loan for that property opportunity. And it's going to be up to you to decide and help them. Hey, look, if it's a small rehab project, maybe 50K or less, you know, you're going to have a hard time beating the pricing and on a regular like Fannie Freddie reno loan, right? But if you've got something that you've got to blow down, and we're talking like fix and flip, you need to understand in the fix and flip market. So the concept, if you put your like think to yourself, like you go out and you start really approaching and marketing to these investment groups, fix and flip markets, you're going to builders and you start getting some of these, and now you have to have a buyer presentation where you're going to present options. You're going to want to know, you're going to want to understand how the reno loans work and how fix and flip loans work, because really you're not going to control what type of property is coming your way from that client, but you're certainly going to want to be able to advise them on all the best options that are there. And so I would definitely encourage you to really learn about renovation loans, how they work, under like go like through like a mock version of one where you have to work on a budget and you have to understand how the future appraised value is calculated. Get smart on like OTC construction lending, because it's very similar. And same thing with fix and flip. That would be my my advice on really not just how to take advantage of rental loans, but really the non-owner market as it relates to kind of like investing, and also you know, renovation or kind of like fix and flip type investing.
Yeah, it's great advice, Ryan. I mean, I could probably spend an hour just on renovation loans, but just two quick things as kind of tidbits, I guess, for the loan originators outside of the topic that we're talking about right now. If you're looking for realtors to call on, and you're seeing multiple listings, you're seeing real estate ads for cash only, or you're seeing listings where they're getting ready to expire and the properties haven't sold. In this market, in most markets, I'm not going to speak for every market across the country, but in a lot of markets where housing is still fairly tight, if a listing is getting ready to expire, it's either a really old, tired property, or it's overpriced, or most likely the combination of both. And what you can do as a loan originator is put together options for these realtors so they can understand what these properties could look like and what that financing package would look like for loan originators. Same thing for all cash. I think a lot of realtors think properties have to be sold all cash, and they probably don't with some of these renovation options. So just things to keep in the back of your head as you're looking to grow your business. Let's go on to the next slide real quick, Harish. And I think we're getting into some really interesting business growth opportunities on the investor side. I think the first one is financial advisors and CPAs. And I'm actually going to kind of couple this with the high trust referral sources, because Ryan makes a lot of really good points about referral options. And we sort of get stuck in this, you know, real estate referral opportunity. And there's a lot of opportunity for referral sources, and sometimes they're actually better. So you want to touch on that a little bit, Ryan, please?
Yeah, for sure. So, and look, I don't think I'm going to be telling a lot of originators out there anything new about places that you can find referrals. Like if you've gone to BNI networking groups or any kind of networking groups, you're probably meeting a financial advisor or a CPA. The idea there, though, is to, one, expand that net into like lots of financial advisors, lots of CPAs. And one thing that I try to, you know, teach and coach our originators is understanding how to speak the language of the financial advisor and the CPA, right? So you need to be able to and as it relates especially to their investors, right? So, you know, why would a financial advisor's client seek them out for advice when buying an investment property? Why would a future borrower go to their CPA to talk to them about buying an investment property? Or why might a CPA recommend to one of their clients, hey, you might want to take a look at buying an investment property, right? To help them with some tax advantages of having an investment property. Same thing with a financial advisor. Like you've got somebody who wants to diversify their portfolio into real estate, right? Those questions come up often, you know, to the financial advisors, and they need a trusted referral source, right? So I would, by being able to speak their language, which is investment property, let me help you and your clients, you know, diversify their portfolio. Let me help work with your clients to employ some tax strategies through investment properties that might help. Those are opening lines and intros to those referral sources that you can certainly use to diversify, you know, your referral stream. Bottom bullet point here is this kind of high trust referral source. And this, I think, is one of the most important things on this slide, in that financial advisors and CPAs, right, are high trust referral sources. And what I mean by that is when one of these people refer you a client, the client typically is not shopping, right? Because the amount of trust that the client has in the financial advisor and the CPA, and I kind of qualify a high trust referral source as any referral source that has your social security number or like home address on file, right? If that person has that on you and they tell you and refer you to somebody, usually they're not going to shop you. And this, when you compare that to like a realtor, right? How much loyalty does a referral from a realtor have, right? Are they not going to shop you on Better? They're not going to shop you on the internet. There's a high probability they will. Whereas when you are helping a financial advisor and their client put together a strategy for their portfolio, they don't want to go outside into the world because they're not confident anybody's going to understand what they're trying to do because it's more complicated. And so the more that you can make yourself a cog in the wheel of those financial advisors, investment property strategy sessions, same with the CPAs, you will see your closing ratio on referrals go up. We also kind of talked on, where do I go out and find non-owner occupied property opportunities? Well, like we talked about, if you just start banging on doors of financial advisors and CPAs, you frankly don't even need to bang on doors. I would just say call all the financial advisors and CPAs that are right under your nose that work with your past clients. Right? Your past clients, I'm sure, would be happy to introduce you to their financial advisors and CPAs, and you can start building a relationship there. But investor network groups, just Google investor networking group, go on Facebook, go on Instagram, search for investor networking groups, go join those groups, and just be a fly on the wall and see how they play out. See where who's participating and what types of questions are there. Lastly, which is also a really important fact, non-owner occupied lending, especially on DSCR loans, they're business purpose loans, and they don't require you to be licensed in multiple states. I'm not going to say all states, but I think there's about 35 or 39 states where you can basically do DSCR loans and you don't need to be licensed in that state. And why is that so important, right? Because, I'm sitting in Southern California, look, investors in Southern California, they don't, you've got somebody who wants to dip their toe in and get their first investment property house. They're not going to be buying a $1.5 million house in coastal Orange County as their first investment property. But where they might be looking is, hey, let's go look in like some hot markets that are growing. Let's, whether it's Boise, whether it's Austin, those have already been played out, but maybe there's areas in Texas, in Oregon, Montana, up by Billings is starting to get big. Florida, Tennessee, you name it. You want to go to those markets where there's lower price points, where your clients can chew off investment properties without getting, if it doesn't work out, they don't get super burned. And they can actually acquire a larger portfolio, which is what their financial advisors and their CPAs will probably, advise them to do. So those are some good ideas on that front for y'all.
Yeah, no, the multiple states and not necessarily having to be licensed. I think Plaza currently offers, is it 35 states, Mark, that we're
35. Yep.
35, right, where you don't necessarily have to be licensed. So it's certainly a great option. One quick follow-up question for you, Ryan. We talked a lot about financial advisors, CPAs. I know this slide's about investors, but reverse mortgage always comes up, it seems like, with financial advisors in particular. And it's a great product for people who really want to age in place. Do you see that product come a lot with those conversations with financial advisors?
Absolutely. And this kind of goes into the same point that I made earlier, right? For us, it's all about becoming an expert in a particular product line. But I guess another way to look at it is becoming an expert around a referral source. So if we were going to say like investment property loans and the builders, the contractors, all of the people that can refer you in that referral funnel, you need to be an expert around all the opportunities that might exist down that referral line. And so if we look at financial advisors as a referral funnel, right, you need to be an expert on all things financial advisors and all of the loan tools that you potentially have access to be able to help their clients, because that's how you become their true referral partner. They're not going to go out and have a separate reverse mortgage person and a separate forward person, because if they work with a really good reverse person, they probably do forwards too. But to your point, look, you've got such an opportunity in the reverse market. The compensation is incredible. So if you haven't done one, I would recommend that you really dive in and actually understand the type of comp you can make on reverse mortgages. You're looking at the baby boom generation. I don't know if you've all heard about the quote unquote silver wave that was supposed to be coming. It's starting to move, but really you had the housing lock kind of stop that. And when we talk about that, that's like even all the old folks with their sitting on their 3% mortgages don't want to move, right? They'd rather sit with their 3% rather than give it up, face capital gains and whatnot. And I'd also bring up, keep an eye out for, it's called the More Homes on the Market Act. It was introduced out of California in 2022. It's sitting on the floor right now in Congress to get approved, which it makes me sad that it started in 22 and it's 2024. So it truly gives you like the glacial speed that things happen. But this would increase the capital gains exemption for homeowners for couples from 500,000 to $1 million. And if that happens, the silver wave, I feel like truly will happen. And so it's not going to happen tomorrow. So you're going to have some time on your hands, but I would get smart on reverse, because as the silver wave happens and those seniors are starting to downsize, they're going to be looking in the reverse purchase market. And that would be a tremendous opportunity for you to be able to take advantage of.
Great. That's fantastic feedback. Thanks, Ryan. Let's go to the next slide, please, Harish. And we're going to start talking about government loans, but in particular refinances. And again,
Yeah.
It's great that we're having to say that word. Yeah, Mark?
Jeff, just one stat I wanted to mention. According to Realtor.com, 14.8% of all purchase transactions first quarter this year were investor. In some states like California, it's over 30%. So
Wow.
if it's not part of your regular portfolio, you're missing out. One other thing I wanted to mention is just the Fannie Mae and Freddie that allowed delayed financing. So if you're dealing with an investor who maybe is getting into being an investor, he's got a chunk of cash, a few $100,000 that they buy a property cash because they're able to buy it faster that way. You can do that cash out almost immediately. He gets his money back, buys another investment property with it, gets his money back, buys another investment property. You can sort of take a chunk of money and turn that into 3 or 4 transactions, using that delayed financing option, because of course you now have to wait 12 months to do cash out on a conventional loan. So just another thing to sort of think about. That one I think is effective when you're dealing with, ones that aren't, a big time investor, maybe just getting their feet into it.
Great. Fantastic points. So refinances, streamlines, government loans, even conventional opportunities. We know that there's a lot of servicing today is comprised with some really large organizations that are pretty good about retaining their customers. So I think, one of the things that we have to think about is how are we going to source refinance opportunities as loan originators? And we're going to kick it over to Ryan to get some feedback on that. I just give you my 2 cents. This is the part of the mortgage cycle, I think, where we have to remind everybody in our friends and family circle what we do. And this is an opportunity to think about, listen, anybody who purchased a home in the last, 2.5, 3 years probably needs to at least be aware of where they are and what opportunities may exist currently. And make use of our social media networks to remind people that this is a good time. We know that there are certainly, a lot of loans that are available and eligible to refinance. There was a lot still in the book that did not refinance through COVID. So those, I don't consider those eligible, even though the rates say they're eligible, but they didn't refinance in COVID. So there's probably not now, but there's still, every 0.5%, there's quite a few million loans that are eligible. So Ryan, maybe we'll kick it over to you and say, how do you see your originators in your broker and non-delegated company sourcing or finding refinance opportunities and competing?
Yeah. So, well, we have a pretty robust in-house tech platform that basically generates like as soon as the refinance opportunities are there, we generate a refinance campaign for all of those customers that are eligible. So it's email and text. So that we're pretty snappy on that, because for us, and it says consumer direct here, I'm a big believer that it's about speed to need, right? The servicing companies are so good right now at retaining servicing. In fact, Mr. Cooper came out, I think they said they have 72% retention rate on their portfolio. And for those originators that don't know, right, obviously, your loans are getting sold, they get sold to the secondary market, but there's an end servicer. Those servicers have retail mortgage companies that as soon as a payoff demand is triggered, or maybe there's a mortgage inquiry, they have all the technology, the same technology we have that's trying to listen to our database. They are there trying to retain that loan, and they're usually doing it at a much lower price than what we are. There was a study that Magic did where it's the average consumer direct loan officer, the folks that are just like dialing for dollars, and the servicing companies, they're running like 60 to 40 basis points lower in price than the average broker. This isn't even like an IMB that might have like pricing way off the moon. This is like brokers like us with sharp pricing. We're having to come down and compete at really low levels with those servicers. So yeah, I would second that it's all about speed to need. In fact, yesterday I was calling and following up on emails and texts that our system had sent out yet, and I picked up 3 refis yesterday. And those are, and you know what? Oddly enough, like they've already seen it in the mail. They've already seen it on TV, right? They're hearing it on the news, so they're ready. And as long as you're maintaining that relationship with those folks, they would, at least in my experience, they want to work with you. But I would say, when this thing's over, I would go through your database and start calling lickety split, because it's on.
Yeah, great feedback. We talked a little bit earlier about reverse loans and some of the opportunities. So Mark, maybe you could talk a little bit about how this rate drop affects reverse business and actually increases the opportunity, and the fact that anybody who's had reverse conversations with someone, earlier this year or most of last year should go back and relook at those right now.
Yeah. So what a lot of people forget about is that rates getting lower, price improvement does impact the reverse LTVs. And because the LTVs that you're getting on reverse are based on what it's going to be like in the future as that lien grows in reverse, right? So if it's growing at a lower rate, it's going to be more opportunity. It won't grow as fast. So more LTV you can get up front. So this is a quick and dirty way of thinking about it. For every quarter drop in the 10-year, you're going to get about 1.25% increase in reverse LTV. So if you look at beginning of June, 10 years about 4.5. Now it's around 3.75. So that's 3/4 of a drop in the 10-year. We've seen about 3.75% increase in reverse LTV. And I know that doesn't sound like a lot, but when you're talking about being able to make some of these loans work, getting money that you need to pay off the lien, pay the closing costs, just get them enough money to make them feel that it's worth it. A $600,000 property, that 3.75% LTV is $22,000. So that absolutely, I mean, we do see these reverses come in, and appraisal comes in a little bit low. We missed the boat by 10 grand, and these people are tight on money. That's why they're doing the reverse. So 10 grand can make a big difference. So as you see, a lot of times what happens is we get busy with other things. And so we put loans like reverse that we're not as comfortable with a little bit to the side. Well, it actually is a benefit to have a lower rate environment for reverse as well, because that does allow you to get a little more LTV. So that helps. And of course, senior equity at an all-time high. The median home equity for a senior homeowner over 65 is $250,000 right now. It's 47% higher than equity was back before 2020. So there is a big need for it with the inflation and people living longer, combined with the housing prices. And there's just a lot of good things happening in the reverse area that can help these seniors that need it when it makes a lot of sense. And we do have a lot of training at Plaza that will help talk you through how to approach the kids of the senior, what kind of questions you ask. So we're very designed for people that maybe aren't super used to doing it. But I'm telling you, once you do one, make it part of your portfolio, because all of the things that Ryan talked about with capital gains bills and the things I mentioned about inflation and people living longer, this loan is here to stay, and it needs to be a part of everybody's loan portfolio.
Yeah, great point. We're seeing the average age of our reverse applications continuing to go up almost every year. And one of the things that we frequently hear about is people were prepared for retirement, but they're frankly living longer. So they're running into a financial and strain as they get older. So great product, as Ryan mentioned earlier, it's something that you need to have in your repertoire as you continue to look out. We're going to kick it back over to Ryan for the last bullet. He's got some really interesting points about mixing refinances and making sure that as a loan originator in today's market that you're very balanced on how you're getting your business. And he's also going to probably hop on one of the questions about, refinance opportunities, cash outs, and, why would people consider it if they're at, a 3 or a 4% rate right now. So thanks, Ryan.
Yeah, for sure. So, great question. Somebody asked, if someone's sitting on 3 to 4%, why would somebody refinance at the low 6s, right? And one of the cool features that our tech does, and this, look, if you guys use Sales Boomerang or Trust Engine or any type of monitor base, any type of data monitoring service, they actually can show you the consumer debt, the amount of consumer debt that people have. And if you just want to go out into the interweb and Google like total consumer debt out there, consumer debt is a huge issue facing the American consumer right now. Even though you had a 0.5% drop in rates, the average credit card rate is 28%. Okay. And if you go and you look at the average amount of credit card debt that an American consumer is carrying, depending on what your target market is, it is significant. Usually, like at least in my market area, I'm looking at my clients with anywhere between $35,000 to $65,000 of credit card debt. And so what you need a tool. MBS Highway is a great tool. Barry Habib's MBS Highway, he has like a household debt calculator. So it's really important. And not only that, but a lot of people, they have equity lines, right? And their equity line, because they wanted to keep that 3 or 4% rate there. So they went out and they got a second for $250,000. And that rate is sitting at 8.5%, 9.5%. They don't know what their blended rate is. You throw on top of that their car loan at 7%, you throw on top their credit card debt sitting at 28%. They have no idea what their total household debt rate is, right? So they focus on that 3 or 4%, and I don't want to touch that. Oh, but by the way, I'm paying, like $700 a month on my credit card bill. I'm paying $1,200 on my car loan, and I got $900 on my equity line, right? What if, so if we bring all that into a 6%, there's a good chance that your overall cash, that you can improve that client's cash flow. All right. But let's just say, you go and you do the math and it doesn't work. At the end of the day, it's still worth having the conversation with that client, right? Like our business about being referral-based loan officers and going out and getting loans is about having meaningful conversations with our database. So even a loan that may not work, just the fact that you're doing the math and you're out there monitoring that for your customer and you're that person for them, that, like we talked about from a trust standpoint, that elevates your trust level. That means the next time they get some random call from some rocket loan officer or some consumer direct guy, they're going to call you. Instead, they're going to be like, hey, this guy called me and said they could do this for me. What do you think? That's what you're after. And those kind of calls do it. So one, there's a high likelihood that person might be able to refi if you look at their total household debt number. But even if not, it's a great conversation, which will help grow your business.
Ryan, what does say, someone else is their wealth manager, you be their debt manager, right? And
exactly right. And you're 100% right, right? And for most people in America, their debt outpaces their investments anyway. So you're managing the most important part of their financial portfolio, which is how much they're spending each month on what they borrowed. As relates to just fishing in multiple ponds, this is kind of like just the summary bullet of what we've talked about, right? I think when you look at where people have been over the last 2 years, the refinance market was locked up. Most loan officers, we tried to focus directly on the purchase market. And for most loan officers, focusing on the purchase market means calling on realtors, and it's realtor, right? And the realtors, there's only so many realtors to go around. And as we're going to talk about in a slide from now, that pool might be shrinking based on the NAR changes. So the concept here is where are you going to actually diversify your own mortgage business into streams that actually are rate proof and they're inflation proof, right? And this gets into that, that non-owner market, right? I showed you that example from our loan officer whose volume did not drop from 21 to 22 to 23, right? That's what the non-owner market can do for you. You start looking at reverse, right? Reverse is a need-based product. right? Seniors need reverses to manage their way through retirement when their retirement plans are being spent through, because to your point, Jeff, that they're living longer, right? So the idea here is, look, if you are focusing just on the purchase market and then refinancing just your purchases, you're missing out on a tremendous opportunity to be a diversified originator that has products in multiple streams that will sustain you in any market cycle, right? If you're looking back and you've got all your bumps, scrapes, and scratches from 2021 until, now when rates came down, like, wouldn't it be nice if that wasn't going to be as painful the next time around? And so I would say, take advantage of the concepts and the thoughts that we've covered with these products to kind of help minimize the impact of the next time the inflation word hits and the next time rates go up to, 7.5, right? Because it's not a question of will they, it's just a question of when.
Fantastic points. Thanks, Ryan. Well, you mentioned realtor. So let's go to the next slide, which is we're going to talk a little bit about the NAR settlement.
Yep. I have one question, Mark. I think you answered that. How do our community get access to trainings? I believe Plaza provides trainings on reverse. So maybe you can answer this for the audience. How do they get access to your trainings and content?
Yes, yeah, we are completely dedicated to people that don't understand reverse. That's okay. That's really what we're designed for, is to help you guys. So we have lots of live trainings. We have recorded trainings. We have lots of sort of like flyers and info sheets that'll help you sort of understand some of the terminology that you can use so that you can sound informed when you're talking with a senior and their children. And so, yeah, if you contact us, you can always email hereforyou@plazahomemortgage.com. That's an easy one to remember. And we'll also have our contact info at the very end.
Thank you.
Thanks, Mark. So NAR settlement. So we've talked a lot about fishing in different ponds. Obviously, realtor referrals is and will always be a big part of our business, but there's definitely some changes that have come as a result of the NAR settlement. So I think the first thing that we'll do is I'm going to kick it over to Mark, and he's going to talk about what hasn't changed. So what remains the same, and then we're going to talk a little bit about the market, what we're seeing, what we're hearing, what we should be doing as loan originators to make sure that we are prepared. I mean, it's obviously already out there, but we're probably still adjusting to the fly a little bit, and we want to make sure that you've got all the relevant information. So Mark, why don't you talk a little bit about what hasn't changed so far?
Yeah, right off the bat, from the lending standpoint, almost nothing has changed. The seller can absolutely still pay the agents on both sides, and it does not count in the interested party contribution max. That's for all products. So they still consider even the buyer's agent to be a normal seller paid closing cost. And so that, that does not impact any of your concession maxes at all, same as it's always been. The one change we did was where VA expanded a few months ago, and they do allow the buyer to now pay agent commissions. That wasn't allowed before, but they obviously did not want to make their veterans not be have as much buying power as a non-veteran. So they do allow the buyer to pay agent commissions. Honestly, other than that, not a whole lot has really changed. If you do have the buyer paying the agent, it would go in section H on the LE, just like it always would. And it's not it's not something where if you miss it at the beginning, you can't add it later. Once you realize that they are paying it, you can add it later. It's not going to be a huge cure, but obviously it makes a lot of sense to disclose it as early as possible, just so that your cash to close figure is accurate. But it's a section H fee if you do have to, if the buyer is paying fees. So that's not, not a huge concern on the tolerance side.
Great. Thanks for that input. Next bullet is what change have we really seen since August 17th? I was actually on a webinar probably a week and a half, 2 weeks ago with the principal of a real estate company. And I think the general consensus in the industry is that real estate commissions will probably come down as a result of the settlement and the fact that it's negotiable now. But this individual actually said that so far they'd actually seen commissions go up a little bit. And so I think that we can all agree that what exists today will probably be different than what exists tomorrow. So in other words, we're still going through some flux and change. I think consumers are still becoming aware of this. People are still kind of figuring it out. But Ryan, I'm going to kick it over to you for what you've seen from your loan originators and, so far, and what kind of comments do you have on what's happened so far to date in the market?
Yeah, so I mean, we haven't seen a ton of, it wasn't like what was it? Was it the year when we changed to 2000, right? That we were going to have like the full global meltdown. So yeah, so it hasn't been a huge deal, at least on our side. I mean, obviously, I think there's carnage maybe going on the real estate side. I think buyers agents have had to get smart. I will give kudos to NAR and to all the local real estate organizations. So one of the things that we did is we kept pushing out all of the NAR information and local real estate board information to our originators, because they had great, I mean, for us to really be able to advise our realtors, we have to understand what they're going through and actually what their organizations are actually, pushing them to do. So there's a ton of great feedback already from their trade organizations that were helping them along the way. As far as, from an originator perspective, how have we leveraged it? Because, and this touches on what we mentioned on the previous slide with calling clients, right? This is just an opportunity, a great opportunity to have conversations, right? It's a great opportunity for you to diversify yourself as a better originator, or as an originator that may have more tools to help your real estate agent, one, put together a better buyer presentation, right? Because ultimately now a buyer's agent has to go and convince a buyer that they're bringing enough value to the table to justify their compensation. All right. Well, one of the main areas that you're able to bring value is like, and it's so funny because in before this settlement, it was like, oh, well, go get pre-approved or go get pre-qualified. Like, we were never really part of the initial conversation. Whereas a buyer's agent that presents themselves as like, hey, I'd like to meet with you with my financial team as well. We're going to help represent you and get your financing in order because it's in lockstep. You can integrate yourself as a part of that upfront value proposition, which is huge. The next thing that you can do is really understand the 4 different ways that buyers can pay for the buyer's agent commission, right? There's the old way, there's financing it into the loan, there's financing it into the actual purchase price. So you want to get smart on that. There's a great video, if you haven't seen it, from Josh Metal out there on YouTube. Josh Metal, he doesn't work for us, he works for another company, but he does a really good job of breaking down those 4 options in like a 5-minute YouTube video. So I tell you guys to go check that out. But it's, again, and that lastly on this, I think what we did have a coach come in to Arbor. Scott Groves from Consolidated Coaching did an hour, like a power hour with us. And one of his points was that the buyer's agent representation market is going to shift more towards the listing agent. So not only, I think, to Jeff's points, are you going to see maybe commissions coming down a little bit, but it's really about who's going to control the buyers. Right? Are the buyer's agent really going to be the ones that are going to have the upper hand to go out and refer clients to us? Or is it going to be the listing agent? And I think listing agents that can offer discounted buyer services at their open house, with like, they'll have a buyer agreement there and just say, hey, we'll do it for you for $2,500 if you buy the house, versus somebody else who's trying to make a full percent commission. So I think it's really going to introduce an aggressive listing agent capture type of open house product or process that originators really need to get in front of. So his recommendation to us was, dust off your boots, get in your car and go start cruising around, get an open house strategy, backfired up again, but really start targeting listing agents more than your buyer's agents, or start building that pipeline up, because that's where he thinks the referral control is going to shift towards.
Those are fantastic points. One of the things I just kind of want to reiterate, I guess, is, and I've heard this from a few other sources, is the need for a buyer's agent. If you're going to maintain to be a buyer's agent, you need to be able to articulate your value proposition. And as Ryan mentioned, you can do that in a team, in partnership with your lending team per se. But the days of just being on call and picking up a phone and catching somebody who's moving to the area, knowing that they're not paying you, and securing that client, those days are, if they're not over yet, they're going to come to an end when people realize that they have other options. So they're going to be interviewing, per se, these buyer's agents, and they're going to have choice, and they need to become better salespeople, in all honesty. And many of us could probably help them in that area because we are good at relaying value, because we sell the number one commodity out there, money. So we're used to selling and propositioning value. What is the value in this transaction? And I think a lot of those people are gonna need some help with that, and that's certainly going to be a key to success for those people. You mentioned another thing too, Ryan, and that's the shift of listing agents getting or garnering more buyer representation through the open houses. So what are you going to see in the market as a loan officer? I guess how would I try to take advantage of that? A lot of those listing companies tend to be the bigger brands too. They can control a little bit more of the market. They tend to have more marketing firepower. So in addition to just kind of going out and hitting the open houses more, how would I shift my agent? And one more thing I just kind of remind as we talk about that is, if I'm a loan officer too, I probably want to be really aware of my book of business and where did it come from over the last 12 months, 24 months. And did I deal with a lot of buyer's agents? And if so, then what Ryan's going to talk about in a second is probably really important to you. So Ryan, comments on that?
Yeah, and if you had buyer's agents, like whose real estate team were they on? And if you're not using a tool like MMI or Redder, some type of data service where you can see the realtors, the listing agents, like who's handling listing sides, buy sides, and actually broken down by office and geography, right? So I mean, if the amount of information that's at your fingertips right now through those tools is amazing. I would highly recommend starting there, right? Because you have to know if there's going to be a shift of where our business and referrals are going to come to in your market area. You need to know who the players are, who those real estate offices are that are controlling the bulk of the listings, and you're going to have to figure out a way to work your way in there. And most of those those teams are teams, and they're rather large teams, right? So just, you don't necessarily need to go to the head of the snake, but you have to find a way to get into that listing side and open up a dialogue with, hey, look, have you seen, and you're asking, a probing question, right? Are you seeing, your strategy change through your open houses to get more buyers? Are you offering discounts? And you can just open up the dialogue with those people to start talking about, are you still going to just have a buyer's agent sitting in the open house? And how are you going to compete, or what are your strategies around accessing or capturing more of those folks? So I do think just kind of the data tools and who you're looking for is really important, because I also think agents that were buy-side agents that were doing somewhere, if they're doing like 2 to 5 transactions a year, I don't know that they're going to survive this, right? Because I don't know that they are going to have the volume or the expertise to compete against with the other folks that are going to start, I think, coming from the other side on the listing agent side.
That's a really good point, and that's something that we've heard in the industry a lot. And that is, are the smaller agents, the ones doing a few transactions a year, going to survive this? I agree with you. I think there's going to be a lot of pressure on that. Although I think there's even more pressure on that sort of next level agent, that one that's doing 6 to 10 or 12, where this is their full-time position, and this is a job for them, not necessarily a hobby, but it's a job for them. And so those are the ones that I think are really going to see some pressure, because they need these transactions versus somebody who's just kind of hanging out and taking some buyer representation as it comes to them throughout the year. So those lower end full-time agents are going to really need some assistance and help. And I think, again, as a loan officer, I'm probably going back and looking at my book of business and saying, listen, how many transactions a year are my realtors, and where are they focused, and are they going to shift? And do I need to go out and not only help them, hopefully, but do I also need to go out and source more business? What's the impact of this going to be on what my book of business looked at over the next 12 or 24 months? So any last comments there, Ryan, about kind of the impact on, the financing side? I don't think, a lot changed. I think a lot of what I'm hearing from you is be ready. Any last comments?
Well, it's just be smart on it. Like, if you haven't read the buyer's compensation agreement, Like I'd tell you to go out to NAR, download, go get the documents yourself as an originator, read the documents and put yourself in the shoes of your realtors and what they're going to have cause you know, how many of our realtors actually get our loan estimate, our CD and look through it and have to go through our conversation that we're having with our buyers? Not very many, but here's the deal. I do that for my realtors. I got the buyer agreement. I was reading through it, and put yourself in their shoes and kind of, you know, put their hat on. How would you be talking to their customer, trying to explain them through that document to explain your compensation, right? And I think once you do that, that will give you some insight in how to have the conversations with them. But look, good agents, right, know how to present their value. And I'll go on record and say, look, a good real estate agent is going to be well worth what they're getting paid to negotiate your price. If we're talking about tens, sometimes hundreds of thousands of dollars that swing in the negotiation, that swing in rolling through the property, looking at home inspections, asking for repairs, asking for concessions. You know, your realtor, a good realtor is worth their weight in gold to help you through that contract and to help you through the negotiation. You know, I think buyer's agents a lot of times got like a bad rap because, oh, I can just find my house on Zillow, I can find my house on Redfin. Well, that's one part of it. Sure, you can find it, but how are you going to negotiate the price? You're going to read through the contract. You know, your earnest money deposit's going to go hard. Who's going to help navigate your contingencies? Who's going to look through your home inspection? You know, there's so many things that they do that present value. They just need to get smart on articulating it. And the more that you can give them confidence that you can also articulate that with them. You can, hey, I'm going to back you up. I know how important you are to this transaction. I can actually inspire some fear in these people. Like, hey, like what happens if like your roof has termite damage? Like it might not seem like a big thing, but if they just painted over it and all of a sudden your eave falls down, you might be looking at like a $15,000, $20,000 repair. But you didn't get that because you use the seller's agent, you paid him $25 and he doesn't care. He just wants to get paid full rip when he sells the house. So, you know, there's you know, you can be a great advocate for your realtors. And I think if you work on that kind of pitch of let me show you how I can justify your compensation for you and help you with this value, I think that will help you build some partnerships and secure the existing ones that you have.
So to kind of summarize, if I'm an originator, you know, what should I be doing? What I'm hearing from Ryan and team is educate, right? Make sure you understand the rules, make sure you understand everything, make sure you understand the position. Understand what you're looking at. The second is create a plan. Make sure that you know how you're going to reach out to those listing agents. Make sure how you're going to adapt. Make sure how you're going to help your current buyer agents sort of transition through this. And finally is execute, take action. So make sure you know, most of this today is probably on the education side. You know, watch the video Ryan talked about. Make sure that you're really in a position, you know, it gets back to selling one-on-one, which is adding value.
Well, look, taking action, sorry to cut you off there, Jeff, but I just want to say, like, you hit one of my favorite buzzwords, and especially when it comes to these things, right? There's a lot of information we covered, right? How am I going to go take advantage of non-owner occupied opportunities? How am I going to go take advantage of reverse mortgages? How am I going to take advantage of NAR to have conversations with realtors? At the end of the day, though, everything that we are actively talking about is to help you have conversations. Right? Yep. If you are not out there having conversations with your CPAs, with financial advisors, with your clients that may or may not be eligible for refinances, with your realtors, talking about like it's conversations. And so if anything, you got to know what the hell you're talking about. So to your point, Jeff, educate yourself and then feel empowered and go have those conversations.
Thanks very much, Ryan. Appreciate it today. Mark, anything last thing to comment on?
Change equals opportunity.
Yeah.
100% of the time, because most people don't adapt quickly enough or well enough. And so anytime there's change, it means there's opportunity.
Last thing I'll say is, you know, to kind of summarize both is get out and make it happen today. And if any of us at Plaza or Ryan or any of us can help you with any of the products that we spoke about today with opportunities or details, feel free to reach out to our contact information on the slide. And with that, Harish, I'll turn it over to you.
I know. Thank you so much. So Ryan, who was the video? There was a video on YouTube. Who was the person? Was it Josh?
Yeah, Josh Metal.
Josh Metal. All right.
Yeah.
So I think few folks asked this question. But again, I want to thank Ryan, yourself, and the Plaza team. So Jeff, you were a wonderful quarterback. I promise we'll do some big plays. So we made that happen. So thank you again for guiding the team. And Mark, I would say you were a tight end. You did a good job in catching the balls and running. And Ryan, you were the best wide receiver. You did awesome in giving all the tips and tricks. And, we did touchdown after touchdown today. So I want to thank this team and hopefully our audience learned something. And like Ryan, you said, the proof is in the pudding. So hopefully some of you will take action on these refi opportunities, or, we talked about non-owner occupied and how to work with agents. So we learned a lot. So yeah, thank you so much. The recording of this video will be available on Arrive's YouTube channel in a few days. So those who want to rewatch this will be available. But I appreciate everybody's time today. Thank you so much.
Hey, thanks for having us, Harish.
Yeah, thank you.
Thank you, buddy. Thanks, Amy.
Thank you. Bye-bye.
Bye.